Hello guys, welcome to another educational video with Ahmed Al-Azaiza of Forex Trading Signal. Today guys, we're gonna go to talk about a very good topic, and actually we have had some lessons or some videos related to the Forex Foundation. So after the sixth lesson, we decided today to have a fundamental analysis and market timing session. So we're gonna go guys in this video to brief you about the fundamental analysis and things you need to be aware. Then we will understand the market sessions and timing. Then we will know how to monitor the four market sessions. And after finishing the sessions, I'll take you through the Forex Factory website. So on the Forex Factory website, I'll show you how to monitor the sessions and how to monitor the fundamental news. Okay, so bear with me, please. We'll start in a moment. So here guys is the fundamental analysis. To understand the fundamental analysis, we have to understand the economic growth cycle here. So basically any economy, it depends on the GDP and the production in the country. So economical growth means that there is a high GDP or raised GDP. The GDP means gross domestic production. So if I have good GDP, that means employment rate will raise, because the more business I have and the more production I have, the more people I need to work. So employment raises, goods and services inflation, because if you have a growth on the GDP and there is employment rate high, so these people, they will increase spending, so the price for the goods and the services will go high as well, because the more spending, the more is the demand, so the more the price goes up, so end up by inflation. So in this case, interest rate will be increased to control the amount of the currency in the market. So increase in the demand, raises of exports, increases in the value, economic superpower. So these are the economic factors, and we're gonna go to explain this in detail in a while. So who control this? When there is inflation, who control the inflation? This cycle of economy is controlled by the central banks. So when we talk about these banks, we are talking about the banks which is mainly required for our trading in the Forex market. So let's detail those banks. So those banks are the Fed Reserve Bank for the USD dollar. If I want to monitor the USD dollar, I monitor the Fed Reserve Bank. If I want to monitor the euro, I monitor the European Central Bank. If I want to monitor the pound, the sterling pound, I monitor the Bank of England. The Japanese yen, I monitor the Bank of Japan. The National Australian Bank, it's for the Australian dollar, as well as the Reserve Bank of New Zealand, it's for the New Zealand dollar. So what is the objectives of those banks? The objective of those banks mainly is to monitor inflation and to monitor unemployment rate and to monitor the currency exchange. So why they need to monitor inflation? Because if you have good GDP and if you have increased the employment, so that there will be more spending from the employees. So the employees earning money. So because they are earning money, they spend more. So the price index will go up, because if I want to buy something, a car or buy anything, okay, the more demands on the car and the housing and those things, the more the prices is going up. So when the price goes up, it reach a level where the spenders, there are some people, they cannot afford to buy anymore because the price is going up. So it is the objective of the bank to monitor the inflation. We call this the inflation. So prices goes up, nobody can buy. So there will be so many products which is not able to be sold out. So we call this inflation. So the objective of the bank to balance the inflation. So what they will do in this case, they will raise, for example, interest rates. So they will pull the money from the market. When they raise the interest rate, there will be no borrowers from the bank. So the prices will go down because nobody's going to buy anymore. Then they balance the inflation. As well as the employment, the unemployment rate, the more jobs you are creating, the more is good for the economy. Because if you increase the employment rate, that means you are increasing the spend rate and you are stopping the lending rate. Okay, as well as the currency rate exchange. The currency range exchange, it has to be balanced, because when you export and import goods, your currency rate is playing a very good role for raising the GDP. If I want to import like cars from America, it's more better for me if I have it from, for example, from somewhere else where the currencies are lower. So it depends. So one of the objective of the banks also to monitor the currency rates. So how these people they monitor these things? They have something called monitoring indicator. So those are the like the some of the monitoring indicator. We have the GDP, the gross domestic production, we have the employment, we have the import prices, we have the trade balance, we have the manufacturing, personal income, and so on. In this lesson here, in this session, we're gonna go to speak about the GDP, CPI, and the employment rate, because it's the most common one between all the banks. So let's go to the employment rate. The employment rate, it's the change on the number of employed people during the previous month. So if I have created a job, that means I have raised the employment rate. So if I have so many applications, that means I have indicator for the rate of unemployment rate. So high unemployment is not good for the currency. High employment rate is very good for the currency. So this is when you see high employment rate, that means more spending, more growth. Okay, because you think about this, your spending, it's somebody else's income, and the somebody else's income is spending for something else. Okay, so think about this. So this one of the indicators. We will talk about how the bank is controlling the employment rates. So one of the like main indicator or main famous indicator for those banks is the GDP, and the GDP it's measuring the production of the country as a cycle from the needle to the factories. And those production, the more production you have, the more money and the growth you will have. Because if you are production country, that means people they will import from you. That means you're gonna go to collect other currencies, and your currency will be spread all over the world, so your currency will be having more value. If you are less production, that means you are importing from outside, your currency will not have a value because your demand is more than your production. So if your demand more than your production, that means you have a inflation. Consumption price index or consumer price index. Now we said if the GDP growing up and the employment growing up and the spending growing up also, because if you have good GDP, you have good employment rate, that means you are having good income, that means you raise your spending. Okay, you spend more, you buy cars, you buy food, you buy house, you buy everything. Okay, because of the increase on the demand on those things, now you have these stuff prices going up. So there are people which they cannot afford to have high prices because there are levels in the people style and people income, right? So the income is not the same. So because of that, there are some people they cannot afford to have high prices. So what will happen? There will be like people working, but they cannot buy anything. Okay, we call this also inflation. prices raise up, people they cannot buy. So what the bank will do, he has a tool also to lower the inflation and lower the prices of the goods and stuff. Now we go to the central bank tools in general. So if I have inflation in general, what the central bank will do, the central bank having indicators and having tool as well. So we were talking about the indicators. Now we're gonna go to talk about the tools. If you have inflation, the bank will increase the interest rate. When they increase the interest rate on the loans will be higher. Okay, so people which they are planning to take cars and houses, they will stop borrowing money from the bank because the interest rate now it's too high, too much. We cannot afford to have that much of interest rate. So by this way, the bank stopping pumping money in the market and pulling the money in the market. In this case, when the bank is pulling the money from the market and the people they are not borrowing any more money, there will be less people borrowing money. That means less people consumption in the market. That means when there is less people consumption in the market, that means the people which they are owning the houses and the cars, now they're gonna go to reduce their prices in order to sell their goods and their stuff. So in this case, when there is inflation, the bank will increase the interest rate. When there is a deflation, like other way around, there is like so many items in the market, but still the people they don't have money to buy it, the bank decreasing the interest rate. So by decreasing the interest rate, the people will come to the bank and they will borrow money, and the bank will be lending so many money at the lowest interest rate. By increasing the interest rate, the bank will pull the money from the market. This is one of the tools the bank they are using. So the interest rate. So when they increase the interest rate, the investor will be excited to put their money in the bank because the interest rate is increased. So they prefer to pull their money bank it and put it in the bank to take interest rate, which is more beneficial for them. So one more thing that the bank does, the bank buying bonds from the government. So the government is collecting tax and spending money on the people. So people like you have unemployment people, the government will spend on them and collect tax from the people which they have income. So this is the way the government balancing between the people. So in this case, the bank pump money in the market to increase the spending in the inflation cycle. So they pump money by buying bonds from the government and giving the government money. And in this case, the government will take the money and will spend it on the people. Okay, and it will collect tax. For in this case, they are increasing the spending of the government. So government will spend. So also the bank playing with the tax and the government spending because it reduces and increases the tax, as well as the bank is able to buy the treasuries and those things. Okay, so this is the tools which they are used by the bank. Finally, here I would like to speak about this timing session. So we'll go to the website and we'll talk about the Forex market timing sessions, because there are some people they have asked me about this, so I have put it with this fundamental analysis. Now, after speaking about these, the GDP and the CPI and those things, I'm going to take you to Forex Factory website and I will explain little bit how to get this news and economic calendar and those. So bear with me, please. So this is the Forex Factory. It's www.forexfactory.com. So if you come here, guys, here you can see this is the calendar for the economic. So if you want to know all these calendars, this is like the GDP for the cat. Let's go, for example, to filter this. Let me filter this for you guys before starting. This is calendar and this is filter. Let me say high impact. I don't want remaining and I want only. Here, guys, you can filter. What do you want? So I want, for example, all the high impact in news or calendar. I want only for this stuff. So here we go. You see, so this is the calendar, okay? So in this calendar, we will have all the economy calendar and all the indicators and all the tools So you can see the BMI, it's German flash manufacturer, it's something like the GDP. You have the FOMIC, okay, you have the bank rates, you see whether we cut rates or we increase rates, the currency. This is all affecting the Forex market here. So if you want to watch the indicators and those things, we can watch them in the Forex Factory. One of the main thing also, you can here filter whatever you want, currencies and those things. You can differentiate. The red one is the high impact one, the amber one is the medium impact one, and the yellow one is the low impact one. So you can select the currencies you want and you can monitor all these things. So the way you want, if you want the US dollar and those things, you can monitor. So this is the CPI, for example. The more good the CPI you have, the more good for the currency. The more good the GDP you have, the more good for the currency. The more good employment rate, the more good for the currency. The more good interest rate, the more good for the currencies. And the other side of this Forex Factory, after monitoring these, you can also as well come to the market and you can here set up your local time. So I have put here Abu Dhabi. So this is, for me, it is off because we don't have an Abu Dhabi daylight saving. If you daylight saving, that means this clock will change here. So the moment you set up this, if you are playing like winter and summer, you put on. If you don't play winter and summer, you don't have reduced the time between winter and summer, then you put it off. So for us, Abu Dhabi, we don't change the timing between winter and summer. So I put it off. So if you realize here, now the time is 10 and it is matching with my time here. So after putting this, I go to the market. Here in the market, I can see the 4 sessions, the Sydney session, Tokyo session, and London session, and New York session. So here, guys, there is a 4 markets. If you look here, there is 4 markets. The Forex market starts with Sydney, and it starts at 2 a.m. Abu Dhabi local time, okay? And this is also the local time in Sydney now, right now. Now it is 5 a.m. The market will open after almost like 4 hours. That means it will open at 9 a.m. in Sydney. But in our local time in Abu Dhabi, it's 2 o'clock. So if you set up these for you, if you are in Italy, if you are in Germany, if you are anywhere in the world, you can set up this based on your local time. So Tokyo, Sydney always is overlapping with Tokyo. Tokyo, Japan, it's opening always after the Sydney by like 2 hours. So it's overlapping with the Sydney by almost like 5 hours or 6 hours. So the market will close in Sydney, then Tokyo will continue, then it will overlap with the Europe market. And the Europe market, it will be open 12 o'clock p.m. our local time, Abu Dhabi local time. Again, if you want to change your local time, change it from here, then your local time will appear. Then this is in New York. If you have 2 green, that means 2 market now is running. If you have only 1 green, that means this market is already finished. This finished, this finished. There will be no 3 market at the same time. Always there will be 2 market only at the time, because this is ending here and it's overlapping with Tokyo, Tokyo overlapping with London, and London overlapping with New York. So just recently, before 1 hour, we have the London market is closed and American is still running. So one more thing I just want to highlight, guys, if you are trading, just see the market. If the Sydney, they have sold the market, you just look to Tokyo, Japan, what they will do. If they have sold it, now you have 2 market selling the market. If you have London, they have raised the market up, they bought the market, that means 2 against 1. If in New York, they have bought the market, that means 2 against 2. Now, if Sydney, Tokyo, London sold the market, and in New York, they have bought the market, that means 3 against 1. So always go monitor the markets and see who's selling, who's buying, and try to understand which way is bigger. There are many people on the buying side or there are many people on the selling side. In this way, you can also decide where to place your position and in which direction. Okay, we'll come back to the calendar. Here we'll explain about this little bit. The red calendars means high impact news. The amber calendar is medium impact news. The yellow one is low impact news. The icon for the circle, the green circle, and the actual bending, it's something like bending. Normally it will appear here. That means now the indicator will come. So let me take you through one example of those thing. Like if you see folder like this, that means something related to the indicator or to the news here. And if you click on it, it will guide you to another website to explain about the fundamental analysis. Here you might have some announcement or videos like the star one. If I take you guys to one of the indicators, I want to take you to GDP or unemployment rate or something like that, so I can explain more. So in this case, I have the unemployment rate, guys, here. If you see, this is the indicator. Now, normally, if I am weighting the indicator, there is no number here. There is forecasting number and the previous number. So normally, if I have this green, that means it is better than the forecasted one. If it's green, that means it's good for the currency. If it is red, that means it's bad for the currency. For example, here it was 6.7. This is the unemployment rate, which is good. It is the unemployment. That means how many persons were not employed. 6.7, it is less than 6.8. That means the unemployment rate is reduced, which is good. That means I have more employment. So in this case, I'm going to open this and just study what is inside. In each news here and in each economy calendar, I have some explanation. Here it says the percentage of total workforce that is unemployed and actively seeking for employment during the previous month. Here it's saying actual less than forecast is good for currency. So the actual was less than the forecast. That's why it is good for the currency. And here it says why this is important for the currency. So if you watch this calendar, it's good. You can monitor and analyze the market. And if you watch the market sessions, you can understand which market is open and when to trade and who's going to close. This one also is going to help you by closing your position, because at the end of this session, these people, they will try to close their deals. At the end of this, these people, they will close, and at the end of this, these people, they will close, and at the end of this, these people, they will close. So it will help you to understand when to open, when to do. So one question I've been asked, which session is good and which time is to trade. I don't believe that there is good or bad time to trade. All the time is effective. The more effective one, central banks, how they are reacting toward their objectives about the inflation and the unemployment. So finally, guys, please, at the end of this session, if you have any comment or any question, please do not hesitate to comment on this video below. Please give us like, share this video with others, subscribe to our channel, and do not forget to activate the bell icon. See you in next session. Thank you very much.